So jumping into the part two notes, this was written when I had a split day and we had an entire like 2 days, maybe even a weekend between income statement method and balance sheet method. I don't really need to review those. I do want to talk, what I was talking about earlier is that these are estimates, and estimates are likely to have some error in them. If we have an overestimate of bad debt, it will roll forward as credit balance from the prior period credit balance, and as the unadjusted balance of the allowance account after write-offs were applied. So, for example, here I have an allowance for doubtful account, and I had a $40,000 beginning balance. So remember, this beginning balance came from the estimate from the prior period. So we took either our credit sales, if it was the income statement method, or our ending balance of the allowance for, our ending balance of our accounts receivable, if we were doing the balance sheet method, applied a percent to get this. And that was all from the end of the prior period and those results. Now it's become our beginning balance. Well, if I only have $25,000 of write-offs during the next period, I have a $15,000 unadjusted balance. Basically, this suggests that I had too much bad debt, too much of an estimate here, because I only had $25,000 of write-offs here. So there's still $15,000 in my unadjusted balance. Whereas if I underestimated bad debt, as the example is down here, this was my beginning balance. This is what I estimated at the end of the prior period. And if I had $60,000 of write-offs during the period, then I have a $20,000 unadjusted balance. And that debit amount, that the fact that it's a debit at all, suggests that I underestimated what my bad debt would be going forward. Basically, all to say that the balance sheet method adjusts for an under or overestimate because it considers the unadjusted ADA balance. So just to give you the numerical proof, right? Here's our overestimate scenario. Let's say that I applied the balance sheet method and I determined that I want a $30,000 balance for ADA. So I want to work up to a $30,000 balance for my ADA. When I've overestimated the bad debt, I only need an additional $15,000. That $15,000 is my bad debt expense. With that same desired $30,000 balance for ADA, if I start at a $20,000 debit balance, then I need a $50,000 bad debt expense credit. And so because I overestimated in the first scenario, I only have to charge $15,000 this period. But when I underestimated, I have to charge $50,000. basically it's like I have to make up for the fact that I underestimated. And in this case, I don't have to charge as much because I already charged too much from the prior period. So the estimates do balance themselves out, but only under the balance sheet method. I want to head into sales returns because that is something where the book does something a little strange.